Over the course of history, the stock market has generally kept creeping up even in the face of war. For example, after the Pearl Harbor attacks, stocks slipped over 3% and recovered within a month. After the Cuban Missile Crisis, we saw stocks rally over 20% in the following year, and also 50% after the start of the Gulf War. This time around, I don't think things will be much different, and in fact, this makes me more convinced about the fact that inflation is inevitable, which is something that I talked about in my last video. The US has already committed a vast amount of resources towards the war in Ukraine, and now it looks as though they may have to commit some resources towards the war in Israel and in the Middle East in general. However, this could actually be conducive to higher stock prices. Why exactly do I say this? Well, in my opinion, this will serve to justify higher fiscal spending, possibly even combined with lower rates and more accommodative monetary policy. And what this means is basically a weakening dollar and probably higher asset prices and inflation. In a situation where we have high inflation, you definitely don't want to be holding cash. And even though inflation can hurt the economy, holding assets such as companies or also commodities and perhaps even Bitcoin can really help protect your wealth. In more general terms, what I'm talking about here is basically liquidity, dollar strength, and overall stimulus, both monetary and fiscal, and how war will affect each of these different things. Now, starting with the dollar, we can actually see a strong correlation, or rather inverse correlation, between the dollar and stocks. And now what we can see is that, in fact, as we saw the threat of war escalate on Friday, what we actually saw is the dollar index, the DXY, begin to shoot up, which of course sent risk assets down. Now, if we actually look at the chart of the DXY, I believe that we're now retracing in an ABC structure, and as we can see, we are close to hitting that 61.8% retracement level, which is a key level of resistance from a technical standpoint. We're also getting quite overbought on the RSI, and that means that we could actually begin a final C wave down in the DXY, which would of course prompt much higher asset prices. Now, from a fundamental perspective, this again coincides with what I believe will be a time of higher geopolitical tensions and probably dollar stimulus. Now, the US is already struggling to find funding. Of course, as tensions increase between countries, it's going to struggle even more. And this means that the US government is probably going to have to rely on the Federal Reserve moving forward to a degree monetize debt. Now, this is exactly what we saw happen in World War I, in a period which was characterized by high fiscal spending, low interest rates, and high levels of inflation, and of course devaluation. Let's not forget that was the time when the gold standard was abandoned and the US dollar was instantly devalued in a matter of days, over 50%. Now, of course, a weaker dollar can translate to higher asset prices, but there's more to this equation than just the dollar, and this is also the fiscal stimulus. Now, since 2020, we have seen a big acceleration in fiscal spending, and this doesn't seem to be stopping in 2023 or 2024, and it's likely that fiscal spending is going to continue to ramp up in the following years. And there's a few reasons for this. Of course, internally, we have much higher costs associated in the future to Social Security, which will keep increasing, and on the other hand, because of the geopolitical tensions, we can expect much higher spending, for example, on defense and other forms of spending. But however, beyond this, it is the threat of war which will justify not just higher fiscal spending in defense, but also higher fiscal spending in general, and probably even more reliance on the government. Now, in the long term, this is also not necessarily great for the economy. I am ultimately a free market economist. I do believe that the fiscal stimulus we're seeing right now will translate to much higher GDP, at least in nominal terms. Again, even though we will lose purchasing power through inflation, in nominal terms, we will see the economy go up. And of course, in nominal terms, we will see stock prices and earnings go up with that. Therefore, stocks are likely a good place to be. Now, as we can see, for example, here, the Treasury General account has been replenished in the last few months, and we are now ready to empty it out as we go into the elections. Of course, Biden and the Democrats will have some strong incentives to try and keep this economy as strong as possible and boost it, of course, through that fiscal spending. And of course, there is a strong correlation between that drawdown in the TGA and stocks, as we can see here. On the other hand, we also have a strong correlation between stocks, as measured here in the SPX, and what we might call general Fed liquidity. Now, the way we calculate net liquidity is, of course, by looking at the Fed balance sheet minus the Treasury General account and the reverse repo facility. So as we can see, the Treasury General account has been sped up to higher levels, it is now going to be drawn down, which will be additive for liquidity. And on the other hand, we have the reverse repo facility. Now, this is actually quite interesting because the RRP is actually coming down close to zero right now. Not quite there yet, but it has definitely been drawn down a lot. Now, some could argue that this means that markets are going to suffer with liquidity, but I would argue that this will only incentivize the Federal Reserve to, at the very least, tamper down its quantitative tightening measures and even eventually begin quantitative easing. In this regard, even though Jerome Powell is trying to anchor inflation expectations by not raising rates, I do believe that there is a kind of hidden liquidity that is going to be expansive in the following days, in the following months and year, and this liquidity will come in the form of less QT and even perhaps QE. What I mean by this is, of course, that the Federal Reserve will be expanding its balance sheet. And from a longer term perspective, this is doubly true if we basically begin to see the federal debt get out of hand. The Federal Reserve will have no choice but to monetize this debt. Now, again, we've seen this happen to hundreds of countries around the world. We saw this happen in the 1940s, and the situation we are today, as I discussed in my last video, is basically that right now. And of course, the breakout of war is only one factor in that basically theory that I have of higher inflation and depreciation of the US dollar over the coming years. With that said, let's get into the nitty-gritty of it and talk about three sectors and specifically three assets that you really want to hold during this time. Now, of course, first and foremost, and perhaps not very surprisingly, what you might want to hold right now is defense stocks. Of course, there are tons of different defense stocks and contractors you can buy right now. Lockheed Martin is, of course, a very famous US company, but personally, I've reviewed before and own BAE Systems. Now, BAE Systems is actually a UK contractor, which has a lot of exposure to the US, of course, and many other countries around the world. Now, I really like this stock because of its robust backlog of revenues. Also, its revenues are very diversified and it has a decently strong balance sheet. The stock has actually pulled back a little bit, but it was up, of course, on the news of war. And again, I expect this company to do very well. So, get some exposure to defense stocks. BAE Systems is a great one. And just to throw another name out there, perhaps Palantir. Now, moving on, of course, war in the Middle East could also bring about great problems in energy distribution and energy supply in general. And of course, in times of war, the owning and storing of energy can really ramp up. We're already seeing China, for example, stockpile energy. Again, stuff I covered in my last video, please go check that out. And in terms of energy, again, there are a lot of US companies you can own, but also in an aim to diversify a little bit away from the US, I personally also own PetroBras. Now, this is a very large Brazilian US oil company, which pays a really handsome dividend and has a very fair valuation. Now, of course, this is due to the fact that it is ultimately a Brazilian company. The government in Brazil is very hands-on when it comes to this company. People are very concerned about the fact that Lula is going to basically derail this company. But nonetheless, I covered this in an article and I will leave the link below if you want more information on that. I do think this is a great company to own long-term and, of course, just energy in general. And finally, of course, we have Bitcoin. Bitcoin is not only a great inflation hedge, but also a great hedge, in my opinion, against geopolitical conflict. Now, a lot of people argue that Bitcoin actually sold off on Friday and over the weekend. And while this is true, let's consider that Bitcoin merely sold off around 10% from its recent high. It's actually at similar levels that it was a month ago, still well above its all-time high. So again, showing great resilience at this time. And in my opinion, both from a technical and fundamental perspective, really ready to head back to even higher highs. Now, from a fundamental perspective, as I've discussed before, Bitcoin can be used as a kind of neutral asset by countries around the world to basically store their wealth and even transact when and if they have any issues with the US dollar. Again, something which is beginning to ramp up with geopolitical tensions. So Bitcoin is that kind of digital gold. It is a lot easier, of course, for people in foreign countries and even foreign countries themselves, their governments and central banks to store and buy, and for that reason I believe it is a great asset to own right now. And I do think that in the future we'll begin to see central banks and even countries begin to stockpile a little bit more Bitcoin, even if it's just to diversify their options a little bit. Now, from a technical perspective, a couple of things to note here. First off, I believe we are now in a wave 4 within a 5-wave structure that should lead us to one higher high before the halving. Now, of course, everyone is also expecting the halving to have a positive effect on Bitcoin due to the Bitcoin halving cycle. This is still in question. I believe that the Bitcoin halving cycle could be a sell the news event. We'll have to see. This is a week away, and I probably do plan to make a video on the Bitcoin halving next. But having said that, in the very long term, even though there may be some volatility to Bitcoin, I do believe that this is a must-own asset as we're to, again, this period of heightened geopolitical tension and inflation. With that said, thank you so much for watching this video. I hope you enjoyed it. War is, of course, a terrible thing, but nonetheless, as investors, we still have to do our best to prepare for it and defend our portfolio and our wealth in this terrible situation. So that is just what I'm trying to do in this video. If you like this kind of content, please subscribe to the channel, and of course go follow me on Substack, where I have my weekly newsletter. I do a lot of other stuff, technical analysis, even in-depth stock reports, share parts of my portfolio, and a lot more. So thanks again for watching, and I'll see you in the next one.